Welcome everyone to our webinar on raising capital for later stage companies. On the slide, you'll see there is a QR code, or there was a QR code, but we'll provide it towards the end of the webinar and let you scan that so you can download that at the end of the webinar as well. Just to introduce myself, my name is Michaela O'Connor and I'm a Senior Associate at LegalVision in our corporate team. Now, before we begin, there is a couple of quick housekeeping items. So the first is you will receive the recording as well as the slides in your email at the end. You can also submit questions in the Q&A box throughout the webinar. We'll aim to answer them at the end, but if any come up that I see that are relevant to what I'm talking about, I might also answer them throughout. There will also be a feedback survey after the webinar as well, which you can complete. So for the next 48 hours, you will also be eligible for a complimentary consultation with LegalVision to discuss how we can help your business. So you can provide your contact details, which is in the survey at the end of the webinar, to claim that complimentary consultation. Now, we will today be talking about preparing for your later stage raise, options for the deal structure itself, some common deal terms, as well as steps to take following the deal's completion. And there will be a Q&A session at the end as well to ask questions. Now, I think there will be a poll that if we the poll up, yep, so you'll see a poll that's just come up. So the question is, what is the number one aspect that you want to find out or feel unprepared for in your next funding round? Now, there's a couple of options there. So understanding later stage fundraising strategies, exploring different deal structures, negotiating common deal terms, planning post-deal integration and execution, and last option, no focus, just here to learn. So if you can just choose option that is relevant for you, it just helps us understand why people are here today. So I'll just give you a couple of minutes just to complete that, and then we'll get into the main part of the webinar. Yeah. So we'll just wait for everyone to answer the poll and then we can continue on. Okay, so based on everyone's answers, the most common answer is negotiating common deal terms. So we will touch on that probably in a little bit more detail than the other topics, so that's good. And then most people were split over all of the other options. They were pretty equally based. So it looks like negotiating common deal terms is the main priority for everyone. And there is quite a few, well, there's the main common deal terms that I'll go through later in the webinar, so that's good. So now we'll get into the main part of the webinar itself. So the first thing that I'll be going through is actually preparing your capital raise. And the main thing in relation to that is due diligence, which I might also refer to as DD, which is what we use to shorten it. Now, investors that do lead later stage funding rounds are usually sophisticated institutional investors, so venture capitalists usually, which are known as VCs, and they do typically contribute quite a significant sum of money. For that reason, it is likely that the lead investor will want to conduct due diligence investigations on the company before actually investing in it. So due diligence itself will give the investor a better picture of the company's risk profile and comfort that it's actually making a sound financial decision before it goes ahead. Later stage companies are obviously more mature than early stage companies, and over the course of their growth journey, they're likely to have accrued a lot of information which investors will want to consider as part of the due diligence process. We also often find that later stage transaction documents will contain a term that states that the investment will be subject to the investor completing satisfactory due diligence. And for that reason, it's really important that the company actually prepares for the due diligence process before it commences the investment round, so that completion of the deal isn't delayed due to due diligence. Now, how do you actually prepare for due diligence? So ideally, before or while the preliminary discussions and negotiations with the lead investor have commenced, the company should have already started compiling all of the documents and information that should be included in the data room. Now, when I say a data room, it's essentially just a virtual location storing space where the company can provide documents and the investor can access those documents in order to review them. Now, some people might use an online data platform provider, whilst others might also just set up a Google Drive. But whichever option you go with, it really just depends on how you want to structure it, how you want to be sharing those documents, and what's easiest for you. But it might also come down to the volume of the documents that need to be disclosed as well, because sometimes Google Drive or similar platforms like that could have a limit on the documents that you can have. The list of materials that the company should actually include in its data room are also quite extensive. So I'll just touch on some of the main key documents that you should be including. You can see a summary of them on your slides as well. The first most important ones: members register, articles of association, and the shareholders agreement if the company does have one already. You should also be including a cap table which sets out the company's share capital both before and after the raise. Any agreements that the company has to issue options or shares or convertible instruments. So example there would be advanced subscription agreements, ASAs, some people refer to them as SAFEs, as well as convertible notes that have been entered into or will be entered into by the company, because the investors will want to see those. You should also include generally a summary of the company's intellectual property portfolio and any related agreements to that. So for instance, founder IP assignment deeds or assignment deeds from other companies if intellectual property has been assigned from them. There should also be the employment agreements between the company and its employees, as well as any key contracts with customers and suppliers, because investors will be interested in those. Now, that isn't an exhaustive list that should be included in the data room, and there will be generally more documents depending on the company in question. Sometimes there might also be documents that aren't already in place, but the investor is requesting, and you might need to prepare them at that time as well. And we do often help clients with that at the time of the due diligence. So an example there might be an investor requests to see an intellectual property assignment deed from a founder to the company so that they can ensure that all of the intellectual property is actually owned by the company itself and that the founder doesn't have a personal right over that. And sometimes that might happen at the time of the investment round so that the investor has that added protection. Now, the next thing we'll go into is actually how you can structure the deal, because there is a lot of different ways to do this, and I'll just touch on some of the main ways. So this is just how you're actually going to raise the money, what the deal structure will be. Now, people will often think of late stage funding rounds as being equity rounds. Now, what I refer to as an equity round is issuing shares immediately in exchange for investment. But sometimes it's actually quite common for mature startups to still do what we call bridging rounds. Now, a bridging round usually uses advanced subscription agreements or, say, convertible notes. Now, often startups might actually do their final raise before they lead into a trade sale or an IPO using a convertible instrument. And that is so that it converts at the exit to avoid the shareholder and pricing complexity involved in doing an equity round so close to the exit itself. So in those instances, they might want to use a convertible instrument instead of dealing with shareholders on the cap table. It's important to note, though, with ASAs, they're only really useful for later stage companies as a bridging round to get finance quickly in the interim. So it's usually just an interim measure before a larger round will actually occur, just based on the nature of an advanced subscription agreement. One of the other types of fundraising structures you could also consider is venture debt. Now, that can take the form of a term loan, facility, or a revenue loan, for instance. Venture debt usually isn't an option for early stage companies because they wouldn't have yet achieved the consistent cash flow they need to demonstrate venture debt lenders that they can actually service the loan at that time. But venture debt is a good option for mature startups who can show that. So it might be the case that the higher interest rate and lender fees under venture debt are still cheaper than giving away equity. And it also limits upfront dilution that can be useful in times of lower valuation. So that's why venture debt might be a good option for later stage funding. Now, there are a few considerations to keep in mind in relation to venture debt. So you will see some of them on the screen. I'll just change the screen now for you. So just onto the next slide. Perfect. So yeah, you'll see some of them in summary there, but I'll go through them in a bit more detail. So the first one is that the lender will likely want to take security over the company's assets. Usually that will take the form of a charge over the assets, and it might be specific assets, it might be a general charge over all assets. But of course, that will put the company's assets at risk if the company is unable to pay back the loan. Venture debt lenders might also want to take a warrant, which is a right to purchase shares at a set valuation, and it gives them the opportunity to participate in an equity upside if the company is doing well. Under venture debt lending, interest rates will generally be higher than a traditional lending institution, so for instance, a bank, and that is to offset the risk of venture debt lending that it is, just given its nature. As a matter of practicality, it's also important just to keep in mind that there aren't actually that many venture debt lenders in the UK compared to traditional investors and VCs who invest in equity. It's a growing market, but you'll probably want to keep that in mind in terms of the actual availability of it as an option. Now, the next thing we will consider is what you might need to think about if you do go down a more conventional equity route. And one of the first things to consider there is the number of shareholders that you currently have and will have after the raise itself. So as the number of investors and shareholders grow, you will need to be mindful of distinguishing between the rights of different investors and different shareholders. So in the early days of the company, it might have been easy to treat all investors equally. So for instance, you might have been regularly reporting the same information to them all at the same time. You might have also been providing all investors or even all shareholders with preemptive rights on further issue of shares in further capital raises as well. But as the number of investors grow, all investors having those rights could actually become quite burdensome. And it could be a hindrance, for instance, for you closing a deal. So an example there would be you want to do another capital raise, you have a lot of minority shareholders, they have preemptive rights under the current articles, and you have to get their consent in order to issue further shares in the company. But there are some minority shareholders who are slow and unresponsive that actually might halt you in issuing those further shares under the next capital raise. So that's something to keep in mind. Now, because of that, when you do go to refresh your articles of association and your shareholders agreement at the next raise, that's actually a good opportunity for you to prioritize the rights of major investors and maybe also limit down the ability that minority shareholders have to slow down or hinder that ability to get things done. So it might be, for instance, removing preemptive rights for certain shareholders, or only giving major investors the ability to have decision-making capabilities for key decisions that they might request. The next thing we'll go through is what we call secondary sales. So this actually might be a way, if you're wanting to clean up the cap table of the company. So might be employee shareholders or early stage investors. They might be happy to participate in what is called a secondary sale. Now, when I say a secondary sale, it's usually where there is a lot of investor interest in the next round. So it's usually for later stage companies, and the round's actually oversubscribed. So there's too many investors for the amount of shares that are going to be issued. And that actually might be an option or an opportunity, for new investors to purchase shares of existing shareholders, such as employee shareholders or early stage investors, instead of actually receiving new shares in the company. Now, as a founder, that could also be a good opportunity for you to also get some cash off the table for yourself. So after you've worked very hard, you've made a lot of sacrifices, you might want to get a return on that investment now, but you will need to be mindful of the commercial ramifications of that. So the first thing to consider if you were looking to do that under a secondary sale as a founder is it's not actually money that the company will be receiving, but rather you will be receiving as part of selling your shares. So you would have to consider whether the company can afford that. The new investors might actually not also allow founders to sell a large amount of their shares. The reason they want founders to stick around, they're also investing in the founder as an add-on, because the founder is the one who's built the company. So because of that, they might want you to still be invested in the company heavily as a founder, and that would be with having shares in the company as well, so that you're looking to grow it. So given that it's not usually commonly used for founders to do secondary sales, but usually just early investors or employee shareholders who are happy to sell their shares at that time. They are actually becoming quite common in later stage financing. So generally, if the round is oversubscribed, investors are happy to consent to structuring the deal with a secondary sale element. And usually, if it makes sense for the company and the founders in those circumstances, they're happy to structure it with that element being a part of it. Now, the next thing we'll go through is common deal terms. So the first is what we call liquidation preferences. Now, this is one of the key deal terms that's often negotiated in later funding rounds. So a liquidation preference refers to the orders that investors will receive a payout and how much they'll receive if a liquidation event occurs. Now, when we talk about a liquidation event, we're usually referring to liquidation or winding up of the company, but it can also be referring to a sale of all or substantially all of the shares in or assets of the company. So as the company grows, you can imagine that you could end up with several different classes of shares. So the company might have ordinary shares, seed preference shares, Series A, B, so on. And that means that one of the key terms to negotiate is whether the new preference shares being issued as part of the new round will rank equally with or superior to the existing preference shares or other shares. Now, a lot of investors, even in later stage rounds, will support equal ranking of preference shares as a matter of principle, so that investors will all be treated equally. But some later stage investors might also argue that because they're investing proportionally more money than early stage investors, they need a greater protection in the event that the company does go into liquidation. Now, from a founder's perspective, it might not be your primary concern, because if the company does go under, as a founder, you're unlikely to receive any financial benefit anyway. And the hope is that the investors wouldn't actually have to rely on the liquidation preference, because if the company has done well, they will be getting back more, and they might actually opt to convert to ordinary shares instead and participate alongside the founders, assuming that it's a non-participating liquidation preference. That said, it's also you will also need to keep in mind when negotiating this that if the company issues new preference shares with superior liquidation preferences to other shares already on issue in the company, the existing shareholders will likely need to consent to that because it will be a variation to the rights attached to their existing shares. So you'll need the consent of existing shareholders if they also have a liquidation preference, if it's going to be superior on the next round. Now, the next commonly negotiated term is what we call anti-dilution rights. Now, most preference shares in later stage financing will have what we call anti-dilution rights on a down round. A down round, when I refer to that, is when a company sells shares at a price per share that is less than the price paid per share in an earlier capital raise. So anti-dilution rights are designed to actually protect investors already invested in the event of a future down round. So in practice, what happens is that the right will grant the investor the ability to swap their preference share for ordinary shares on a liquidation event of the company. At that time of the liquidation event, they will receive a greater number of ordinary shares if the anti-dilution rights had been activated throughout the life of the company. So that's how in practice it works, as opposed to what some people think, that if an anti-dilution right is activated, the investor just gets further shares at the time of the down round. That's not what happens in practice. In practice, it's triggered when there's actually a liquidation event or an exit event. In the UK, anti-dilution rights are usually also determined on what we call a broad-based weighted average, meaning that if a down round occurs, investors don't actually get the full adjustment of the lower share price. They'll get something in between the price that they paid for their share and the down round price itself. As the company grows and you undertake different financing rounds, you will also need to be mindful of how those anti-dilution rights will interact with other interests that the company has in place. So, for example, if you're putting in place anti-dilution rights for a new round, you need to have a look at what the company has already offered. So if there's any existing warrants or convertible securities that have a discounted conversion mechanism, they might actually trigger anti-dilution rights. So at the time of negotiating the anti-dilution right and drafting those clauses, they need to be structured to take those other rights into consideration so that it doesn't automatically trigger the anti-dilution mechanism. Another common deal term is forced exit provisions. So these are actually becoming more common in later stage funding rounds, particularly where you have a lead investor that has a private equity background or something similar. Those types of investors will be eager to ensure that the company is motivated to achieve an exit, and that usually is within a certain time frame. So when I talk about an exit, that usually refers to an IPO or a sale of all or substantially all of the company's shares or assets. The form that the forced exit provision comes in can vary. So it could be as simple as requiring the company to use best endeavors to undertake an IPO within a certain time frame, or it could go as far as actually requiring the company to undertake an exit or IPO based on a recommendation of a particular advisor or the availability of a purchaser at the time. Now, the time frames in which the exit provisions are triggered also vary, but often you'll see it's around 5 to 7 years from the initial investment for that to be triggered. So once the deal is actually done, you'll also need to consider implications of raising that significant sum of money from a corporate governance perspective. So the first thing that you'll need to keep in mind is shareholder or investor consent matters. the company's shareholders agreement might actually require certain decisions to be made by a percentage of shareholders, so usually like 75% of shareholders, or in some cases, they may require the consent of particular investors, so key investors, if that had been negotiated when they're investing. So it's important that following completion, once those shareholders are on board, the company actually ensures that it's complying with its shareholders agreement and getting the consent of shareholders or certain investors for any matters that require consent under the shareholders agreement. It could also be under the articles, but generally you'll see consent matters under a shareholders agreement. The shareholders agreement could also set out what we call information rights. So that can be updates on financial performance or management accounts, for instance. And usually you, as the company, you have to give those to the shareholders or particular investors at certain times. So it might be quarterly, and the company will need to make sure that they're across those requirements to ensure, or in order to ensure they comply with them. Those requirements are usually set out in the shareholders agreement, like the other rights, but it could be in the articles as well. And it's usually negotiated at the time that the investor's coming on board. The other thing to consider is audited accounts. So in the UK, most private limited companies won't actually need to be audited. However, you may be required to get an audit if the articles of association say that you must, if at least 10% of the shareholders ask for one, or if the company doesn't fall within the exemption. So you'll see the exemptions on your screen. Now, from 6th of April 2025, the company can qualify, or a company can qualify for an audit exemption if it has at least two of the following that you can see on your screen. So that's an annual turnover of no more than £15 million, assets worth no more than £7.5 million, or 50 or fewer employees on average. So you can qualify for an audit exemption if you have two of those. Now, if you have raised a large amount of cash, it's likely that you might actually tip over that asset value, and you might be required to start preparing audited accounts. So what we've done is there is a high-level overview of audit requirements on the government's website, and we've actually provided a link for you on the slides. So you'll see that at the end of the webinar when you get the slides as well. And that's just a good summary on audit requirements from the government. Getting an auditor can also be expensive, so that's something to keep in mind. But even though they are expensive, it could be a great opportunity to mature the company's reporting practices, get its affairs in order, identify any issues in the company's financial or tax history, for instance, and then that might also allow you to avoid any nasty surprises and fix up those mistakes as well. Now, that actually concludes the main part of our webinar. Now, there is a startup manual on your screen that you can see. So there's a QR code. So I'll just give you a moment to scan that. You will also get the slides at the end. It's just a great publication on various things that you should be considering as a founder. Good startup manual. It goes through capital raising as well. So I'd recommend having a look at that. We also have an upcoming event. So our next webinar is actually next Tuesday, the 6th of May at 11 a.m. So it's employees versus contractors, protect your business from costly status mistakes. So that might also interest you as well. And there's a link there that you can sign up to that webinar. Again, the link will also be accessible at the end as well. Now, we will answer some of your questions shortly. So ask that you submit them in the Q&A chat box now if you do have any questions. And whilst you're submitting them, I'll just go through a bit about LegalVision's membership. So if you are interested in becoming a member, it's essentially a way to get unlimited access to our team of specialists, corporate and business lawyers, for all your business as usual legal needs. So kind of like having your own in-house counsel, but for a fraction of the cost. Some of the things that we can help you with, you'll see on the screen. So unlimited document drafting, reviewing of business contracts, unlimited legal advice consultations, and domestic trademark registrations, but there's also more. So something to consider if you are interested. If you are also an in-house counsel, we do also offer a dedicated service to manage your high volume business as usual legal tasks as well. So if you're interested in that, you can request that complimentary consultation at the end, in the survey at the end of the webinar. And now we'll go through some of your questions. So we have about 10 to 15 minutes left to answer some of your questions. So if you haven't submitted them, you can do that now. So I'll just take a look at some questions that we've had through. Okay, so the first one was actually submitted before the webinar. So I'll just have a look at that now. So the first question is, how can a tech startup raise money? Now, we had actually previously done a webinar on capital raising essentials for startups, which is actually on YouTube. So that might actually be a good starting point for information about that, because it's probably something that I can't really explain in the next 10 minutes because there's various ways to raise capital. So that webinar is called Capital Raising Essentials for Startups, and you can just find that on YouTube. And it was done by LegalVision as well. Myself and my colleague Sarah, we ran that. But in short, there are two main ways that you can raise capital. It's the same for any type of company generally, not just tech startups. So you've got what you call equity or debt financing. So when I refer to debt financing, the main traditional way that you would usually see that is a traditional loan, so a bank loan, or maybe even an investor lending money to the company in exchange for earned interest in return. The other way is equity financing, and the most traditional way that you see that is the company issuing shares in exchange for the investor giving money to the company for those shares. So they're the two main ways, but there are various ways that you can structure it. So I'd recommend looking at that webinar previously as a starting point. And then you could also request the complimentary consultation at the end to see how we can assist you further as well. The next question is, how does a secondary sale work in practice? So in practice, I sort of explained it before, but in practice, usually what it means is an existing shareholder of the company will sell their shares to an incoming investor rather than the company issuing new shares. And the reason for that is under the round, if it is oversubscribed, so there's too many investors wanting to invest for how many shares the company is going to be issuing, they would obviously not be able to receive the shares. So in order to do so, they might get it off a current shareholder instead. So it will essentially mean that shareholder, if they sell all of their shares, is bought out. They're no longer a shareholder, and they gain their return before an initial public offering or an acquisition if they don't want to be included in that. Usually, it only occurs where that funding round is oversubscribed, though. Another question is, what are some common mistakes that later stage startups make during the fundraising process, and how can they be avoided? So I think a big one here is not actually being prepared for the round itself. Normally with initial stage investment, it might be quite informal. Investors might not be as sophisticated and might not be requiring that due diligence process I mentioned. And so usually later stage companies might presume that it will operate in the same way. But generally, if you've got sophisticated investors, particularly VCs, that's not how they will structure it. It will be quite formal. They will want to do extensive due diligence. They will want warranties in relation to the company, all of those sorts of things. So one of the main pointers is to be prepared for the round itself. So you need to make sure that you're ready for the due diligence in particular, have all of your legal contracts in place by that time as well. So if, for instance, you had a developer develop an app for you, you didn't have a development agreement in place, there was nothing confirming who owned that intellectual property, an investor would be questioning, why isn't there a development agreement? There is a risk that the company doesn't own that intellectual property, and they may require that at the time. So that's the things that they would be looking at. Also important to make sure you've got all financial documents, business plans, projections prepared and vetted before you approach an investor. So that might also involve approaching a valuer to value the company correctly before you actually go out and seek investment. And it's important to speak to a qualified valuer for that as well, to properly value the company. Another pointer is keeping current investors or shareholders informed, particularly where they have preemptive rights over further shares or may need to approve a further allotment of shares under the Companies Act. If you don't keep them informed and it comes as a shock to them, they might not be very happy if you're going to be diluting their shares down and might drag their heels or not agree to consent to that, and that can cause some issues for the further round. So you should really keep current shareholders and investors involved in that process, keep them up to date and updated with what's happening. And that also just maintains that trust between the company and the investors as well, so they know what's going on. So I think we probably have time for one more question. So I've just got one last one here I can see. So it looks like, so can you discuss some strategies for managing relationships with multiple investors from different funding rounds, especially when their interests might not always align? So just going back to my point before around keeping current investors or shareholders updated, that is one of the main ways to keep them aligned with new investors as well. But I think this question is probably more meaning if you've got multiple investors with different rights, how you, I guess, navigate that. A big one is just communication with all of the investors. So be open about the company's performance, positive and negative, as well as future plans. That will help to build trust between the investors, the shareholders, but also, be open about with current shareholders about what the new investors are requesting. And if that is a higher preference, then you need to let the current shareholders know that. They may need to consent to that as well. So that open communication will help with that process. You should also, where possible, if you can align interests of different investors, that is great. So one example would be if you've got, say, a tag along clause, which is where if the company, or if like majority of the shareholders of the company are selling their shares, minority shareholders can tag themselves onto that sale. In those instances, you might just grant that right to all shareholders to align their interests in that. But also just be clear about what the company is looking to do, its goals, from the outset, even before they start investing, and that might minimize any conflicts down the track because they're already aware of that. But yeah, that's probably all I've got to say on that. And I think that's all the questions we've got. So I might just give a minute if anyone wants to propose any other questions. If not, I'll finish off the webinar. So I think no, so there's no other questions coming in. If you do think of anything else that you want to ask, you can leave your details, as I said, in that complimentary consultation at the end of the webinar in the survey. And then you can ask those questions and we can discuss how we can assist you further within that. But otherwise, I think that's all we have time for. There's no other questions coming in. So I'll probably just finish off the webinar now then. As I said, if we haven't answered your question, complete that survey and you can request the complimentary consultation, ask any questions that you may think of now. Whilst it is a free webinar, we do also value your feedback. So in the survey, it only takes 30 seconds. If you can give us your feedback, that would also be appreciated. But thank you all for joining us and yeah, have a good day. Thank you.